You know that specific feeling, right?
Oh, I know it well.
It's almost a physical sensation. You wake up, maybe you're having a great morning, sun is shining.
Yeah, coffee's brewing.
Coffee's brewing, exactly. And you grab your phone, you're not even planning on it, but your thumb just sort of, it drifts.
It has a mind of its own.
It does.
Yeah.
Right over to that little finance app. The one you promised yourself you'd only check, once a week.
The modern reflex. We're all just tethered to that data stream.
We are. And you tap it. And just like that, the sunshine, the coffee, it all just fades away because the screen it's just red.
A sea of red.
A sea of red. Every single arrow is pointing down. The percentages are all negative. It looks like someone just, spilled paint all over your future.
It is a visceral shock. I think, psychologists might even call it a kind of micro-trauma.
Really?
Sure. The brain literally sees red. And the amygdala, the fear center, it just fires up. It signals danger. It signals loss.
It absolutely feels like danger. It's that pit in your stomach and your internal monologue just starts spiraling.
Mm-hmm.
You're thinking, okay, this is it. This is the big one.
The bubble has burst.
The bubble has burst. The sky is falling. I'm going to have to cancel that vacation. I'm going to have to start looking at vans down by the river.
Right. It's an immediate jump to the worst case scenario.
And then you make the biggest mistake. You open a news app.
Oh, no.
And the headlines are just pouring gasoline on the fire. They're screaming words at you. Crash, plunge, collapse.
Bloodbath. That's always a popular one.
Bloodbath, yes. It feels like total unmitigated chaos.
And it certainly feels that way to, the individual investors sitting at their kitchen table. But here's the thing, and this is really the core of what we need to get into today.
Okay.
If you were to walk onto a professional trading floor at that exact moment, or, more accurately in 2026, if you looked into the logic centers of the trading algorithms, you wouldn't find chaos.
You wouldn't find panic?
No. You would find a playbook.
A playbook. That is exactly what we are here to talk about today. Because while the rest of us are hyperventilating, the financial experts, the historians, the quants, they are looking at that same sea of red, and they're measuring it. They're using a ruler. They aren't screaming. They're classifying. Exactly. They have a specific name for what is happening. And contrary to what your anxiety is telling you, it is usually not the apocalypse.
No. Usually it's just a correction.
Today on the deep dive, we are tackling the market correction. And our mission, it's pretty simple, but I think it's incredibly important. We want to take you from that state of panic.
Right.
Where you're watching your portfolio shrink and your heart rate is just going through the roof, and get you to a place of understanding. We want to look at the precise mechanics, the hard definitions, and the history of what a correction actually is. Because in finance, words really matter. Precision matters. A bad day is not a correction.
A crash actually has no technical definition. It's just a scary word we use. But a correction. A correction is a mathematical certainty. It has boundaries. It has rules.
And knowing those rules can save you.
It can save you a lot of anxiety, and it can probably save you from making some very, very expensive mistakes, like, selling everything at the absolute bottom.
Which is what your panic is telling you to do.
Always.
So we are pulling this straight from the data. We've got our sources here, and we're focusing specifically on the definitions and historical data found in the Wikipedia entry for market correction. And I have to say, prepping for this, I was surprised by how much I thought I knew, but didn't.
It's one of those terms we hear so often, we assume we know the specifics.
Exactly. And the source includes some really fascinating, really specific data from the year 2025 that we are definitely going to get into later.
Oh, that was a textbook year for this concept.
Right.
I mean, if you want to understand the anatomy of a market drop, the 2025 event is the perfect specimen. It's like a lab sample of market psychology and math just colliding.
It really was. So the goal here is, by the end of this hour, the next time the market dips, and let's be honest, that's what markets do.
It's inevitable.
You're going to be the smartest person in the room. You won't be freaking out. You'll be looking at the chart and saying, yes, we are approaching the threshold. The mechanics are at work.
That is the goal. To replace emotion with mathematics.
I love that.
To replace fear with recognition.
So, okay, let's unpack this. We hear this term all the time on the news. The market is in correction territory. Stocks are correcting. But let's start with the absolute most basic question. What exactly is a correction? Is it just a vibe? Is it just when everyone feels gloomy?
No, if we look at the source material, the definition is it's actually incredibly rigid. It is not a vibe.
Okay.
It's not a sentiment. It is a number.
Yeah.
A stock market correction is typically defined as a drop of more than 10% in the value of a stock index.
10%. So that's the magic number.
That is the magic number. And the source is very, very specific about this. It's not just a folk wisdom thing. It actually cites reputable institutions, U.S. News, the New York Times, as the standard bearers for this exact definition.
So it's an industry consensus.
It's an industry consensus, a hard line in the sand.
Okay, so let's play with that for a second, because that specificity is what people miss, I think. If the market drops 9.5%, what is that?
Then you are just having a bad run. You are in a dip, maybe a pullback.
A slump.
A slump, sure. But technically, you are not in a correction.
And if it drops 10.1%,
boom, the label changes instantly. You are officially in a correction.
it's so interesting that it's such a bright line. I feel like in just, regular conversation, we use correction to mean things are just cooling off. Like, oh, the housing market is correcting, and we just mean it's not totally insane anymore. But for stocks, there's a distinct mathematical threshold.
And that is where that colloquial, that casual usage gets us into trouble.
Go say.
In the world of financial economics, as our source highlights, these terms trigger different responses. Institutional investors, algorithms, pension funds, they often have rules, written right into their charters or their code.
Oh, wow.
That trigger based on these definitions. So the difference between a 9.9% drop and a 10.1% drop isn't just a fraction of a percent. It's a fundamental shift in status. It changes the narrative entirely.
So it's like the difference between a tropical depression and a Category 1 hurricane.
That is a great analogy.
One represents bad weather, the other initiates emergency protocols. The wind speed might only be a few miles per hour different, but that classification changes everything.
It changes everything. And just like a hurricane, the measurement of a correction has very specific rules on how you track it. You don't just, stick a wet finger in the wind.
Right. And this is the part that I found really tricky when I was reading through the source. When do you measure it from? Is it from January 1st? Is it from yesterday's class? Is it from the moment I personally bought the stock?
This is probably the most important concept to grasp, and it's one that the source highlights very clearly.
Okay.
Corrections are almost always measured retrospectively.
Retrospectively. So looking backward.
Exactly. You measure from the most recent high
The most recent high.
to the lowest closing price.
Okay, walk me through that. Because retrospectively implies we don't really know what's happening while it's happening.
That's the tricky part.
Yep.
So let's visualize it. Imagine the S&P 500 hits a new all-time high on a Tuesday.
Yeah.
Everyone's celebrating. The bulls are running. Champagne corks are popping on Wall Street. That Tuesday, that specific day, is your recent high. That's your anchor point.
Got it. Tuesday is the peak of the mountain.
The peak of the mountain. Then on Wednesday, the market drops 2%. On Thursday, another 3%. The next week, it just keeps sliding down.
So we're in the slide. The accounts are bleeding. I'm feeling that pit in my stomach again.
You are in the slide, but you don't actually know it's a correction yet. You're just watching your money evaporate. You might think, oh, it's just a dip. You might even think, hey, good time to buy. It is only when that drop crosses that 10% threshold, calculated specifically from that Tuesday high.
That one specific day.
That one specific day that you can then look back and say, okay, we are in a correction.
So you can't really know you're in a correction until you're already correcting.
In many ways, yes. Think about it like a storm system.
Okay.
When the rain starts, you don't know if it's just a sprinkle, a thunderstorm, or a torrential downpour that's going to flood your basement. You just know it's raining.
Right.
It's only when you look back and you say, okay, the water level hit this mark that you can classify the storm. In the market, you're looking at the peak, the absolute highest point the index reached, and then you are measuring the fall from that specific peak.
That makes sense logically, but it's also kind of terrifying for the investor, isn't it?
It is.
Because while you're in the middle of that 5% drop or that 8% drop, you don't know if it's going to stop there or if it's going to trigger that 10% label. You are living in total uncertainty.
That is the price of admission for being in the stock market.
Yeah.
Uncertainty is the currency.
That's a good way to put it.
But the definition helps frame the history. When we look back at financial history, we ignore the 8% drops. They're just noise. They're blips on the radar. The 10% drops, the corrections. Those are the signals. Those are the events that get recorded in the history books. They signify a meaningful shift in valuation.
So if I'm looking at my portfolio and I'm down 10.5% from where I was last month, I can officially turn to my spouse and say, honey, we're surviving a correction.
You can.
Yeah.
And I think there's a psychological comfort in that.
How so?
It's not just random chaos anymore. It's a recognized, defined market event.
Mhm.
It has a name. It's happened before many, many times, and it will happen again. It's part of the natural life cycle of the market.
It's like getting a diagnosis, right? Once you have a name for the problem, it's less scary. Oh, I just have a correction. It's not some mystery illness anymore.
Precisely.
Mhm.
And just like an illness, the symptoms are very specific. And knowing those symptoms helps you distinguish it from something much, much worse.
Let's talk about those symptoms, because a correction isn't the worst thing that can happen, is it?
No,
It's bad, it hurts, but there's something worse out there, the monster in the closet.
there's always something worse. And this brings us to the next big critical comparison in our source material, the difference between a correction and a bear market.
Yeah, bear market. That's the term that really strikes fear into people's hearts.
It does.
That sounds like years of eating cat food. That sounds like newsreels from the Great Depression.
And justifiably so. If a correction is a tropical storm, a bear market is the Category 5 hurricane that just sits over your house for a week and tears the roof off.
Okay, so if 10% is the line for a correction, what's the line for the bear? Where do we cross over into that real danger zone?
The source defines a bear market as a sustained drop of more than 20%.
20%. Okay, so double the trouble.
Double the percentage, yes.
Yeah.
But here's where it gets really interesting. The source material points out a distinction that goes beyond just the math. It describes the nature of the drop.
Right.
And I think this is fascinating because it sort of contradicts how we often feel in the moment.
Yeah, I saw this part. It used 3 very specific adjectives to describe corrections compared to bear markets, and they were not the words I expected. I expected the bear market to be described as the more violent one.
But it's the opposite. The source describes corrections as shorter, sharper, and steeper.
That sounds violent. Shorter, sharper, steeper.
It does, doesn't it?
Ah,
Let's break those down because they really paint a picture of what living through a correction actually feels like.
Okay, let's start with sharper. What does that imply?
Sharp implies a knife. It implies a cut, something sudden. Painful, but clean in a way. Think of the angle of the line on the chart. A bear market might look like a long, rolling hill going down, or a slow staircase. A correction looks like a cliff. It just drops fast. It takes your breath away.
And steeper.
Hmm.
That sounds similar.
It's the same idea, really. If you're hiking and the trail gets steep, you're descending very rapidly over a short, horizontal distance. In market terms, it means you are losing a lot of value in very, very few trading sessions. You go to lunch, you come back, and the market is down another 2%.
Okay, so fast and brutal. And then the last one, shorter.
And that's the glimmer of hope. That is the silver lining in all of this.
Right.
Shorter means it doesn't last forever. It is an event, not an era.
An event, not an era. I like that. Now, contrast that with how the source describes a bear market.
The source describes a bear market as a sustained drop.
Sustained. Ugh, that word just feels heavy.
It feels like a weight, doesn't it? A sustained drop is one that grinds on and on. It's not just a shock, it's a trend. It's month after month of pessimism. It's the slow, painful erosion of value.
It's not a cliff. It's a long, slow slide into a ditch.
It is. It implies a fundamental shift in the economy where optimism just drains away over time.
Yep.
It's like a slow leak in a tire that eventually leaves you completely flat on the highway in the middle of nowhere.
So the correction is like a flash flood. It's violent, it's scary, it's fast, but then it's over.
Exactly.
And the bear market is like a drought. It just dries everything up over a long, agonizing period.
That is a brilliant analogy. The flash flood, the correction might actually do damage more quickly. It's sharper. It feels more intense day to day. But the drought, the bear market, that changes the landscape for a long, long time. It changes behavior.
It's just so fascinating to me that the correction is described as sharper and steeper. You'd automatically think the bear market, being the bigger percentage loss, would be the steeper one.
Not necessarily.
Yeah.
A bear market can be a death by 1,000 cuts. It can drop 1% a week for 20 straight weeks. That's a bear market. But a correction might drop 10% in just 3 days. That is sharper, is deeper. But the total loss ends up being less.
So the correction is more dramatic in the moment, but the bear market is more fatal in the long run.
Precisely. The correction is a panic attack. The bear market is a clinical depression.
Wow. Okay. That really, really frames it. And I think this distinction is so important because when we see that sharp, steep drop, our brains immediately assume it's the end of the world.
Right. This is the big one.
But if we know that sharp and steep is actually the signature of a correction, which is the lesser of the two evils, maybe we can stay just a little bit calmer.
That is the hope. You recognize the signature, you see the chart, and you say, "Ah, this is sharp, this is steep, this fits the profile of a correction. This is the flash flood, not the drought."
Now, we can talk about definitions all day, but nothing beats a real-world example.
Nothing does.
And the source gives us a doozy. It doesn't reach back to 1929 or 1987. It looks at something very, very recent.
Yes, the 2025 example.
And this is where it gets really interesting. Because if you were an investor in 2025, you lived through this, you felt this. But looking at the dates and the numbers now, in hindsight, it is just a masterclass in what a correction looks like. It's almost like the market read the textbook definition and said, okay, watch this.
It really is. It checks every single box of the definition we just discussed.
Yeah.
It illustrates the timeline, the magnitude, and the recovery perfectly.
So let's look at the timeline. The source identifies the start of this correction, that recent high we talked about, as February 19th, 2025.
Okay, so let's set the scene. Mid-February. Winter is ending. The market is at a peak. Everyone is feeling good. Portfolios are looking fat. People are probably planning their summer vacations based on their 401k gains.
And then the turn, the drop begins. And it does not take long to find the bottom. The source says the lowest point was reached on April 8, 2025.
Just think about that duration for a second. February 19 to April 8.
That's, let me do the math here. That is less than 2 months.
Roughly 7 weeks. About 48 days. That is incredibly fast.
That is the literal definition of shorter. In less than 60 days, the market did all of its damage and hit rock bottom.
And sharper, too. I mean, to lose that much value in just 7 weeks, that must have felt like an absolute free fall.
Oh, absolutely. If you were checking your account in March of 2025, it would have felt like the world was ending every day. Just down, down, down.
Yeah.
That fits the steeper description perfectly. The angle of the line on the chart would have been almost vertical. You're looking at it thinking, is there even a bottom, or does this just go to zero?
But here is the number that really blew my mind when I was reviewing this. We talked about the 10% threshold for a correction and the 20% threshold for a bear market.
Right.
How much did the S&P 500 drop in this 2025 event?
According to the source, it fell exactly 18.9%.
18.9%. Just let that sink in for a moment.
That is excruciatingly close to being a bear market.
It is 1.1% away from being reclassified as a bear market.
Can you just imagine the tension on April 8th of that year? The market is down 18.9%. If it drops just another 1.5%.
Everything changes.
The headlines change from correction to bear market. The algorithms change their behavior. The psychology on the street changes. People start talking about recession and depression.
It was teetering right on the edge of the cliff. It's like a car skidding on ice and stopping with its front wheels hanging right over the canyon.
Wow.
And this highlights why these definitions are so fascinatingly precise. Technically, mathematically, it was a correction. It stopped at 18.9%. But emotionally, if you lived through it,
Yeah,
that felt like a bear.
totally. I mean, if you lose almost 19% of your portfolio, you aren't sitting there comforting yourself by saying, well, thank goodness I didn't lose 20%. At least it wasn't an official bear.
No, you are not popping champagne because you only lost 19%. You're probably feeling physically ill.
You're feeling sick.
But for the historians and for the economists, that distinction matters. Because it stayed under that 20% line, it goes into the history books as a correction. It maintains that identity of being a short, sharp event rather than a sustained collapse.
And it really was short, because let's look at the other side of it, the recovery. We hit the bottom on April 8. The bleeding stopped. So when was it all over?
The source states that the index set a new all-time high on June 27, 2025.
So from February 19th to June 27th, the entire drama, start to finish, peak to new peak.
Yep.
That's just over 4 months.
4 months. You blinked and you missed it.
Yeah.
Well, you didn't miss the pain, but in the grand scheme of a 30-year investment horizon, a 4-month dip is a blip. It's a footnote.
It's a blip, but what a roller coaster of a blip.
And that is the classic profile. It hits hard, it hits fast, and then, and this is so key, it recovers.
Yeah.
It bounces back.
That brings us to a really important rule about recovery, because I think a lot of people get this wrong. I know I sort of did before really digging into this. I always thought about what recovery means in the wrong way.
Ah, okay. What's the common misconception?
Well, I always figured a correction was over when the bleeding stopped, you know? Like, okay, it stopped going down for a few days. We're stable. Phew, correction over. Or maybe when you gain back, say, half of what you lost, you think, okay, we're on the upswing now. We're good.
No. That is not how the math works. And the source is very, very strict about this.
So what is the rule?
The rule is this.
Hmm?
Corrections end once stocks attain new highs.
New highs. Not just get back to even. New high.
New highs. You have to claw back every single penny you lost, and then you have to add one more penny on top of that. You must exceed the previous peak.
So if we look back at our 2025 example, even though the bottom was April 8, we were still technically in a correction on April 9, and on May 1st, and on June 1st.
Yes, absolutely. Even though prices were rising through May and early June, and people were probably feeling better,
Sure, feeling relieved.
you were still living in the correction era. Until that one moment on June 27, 2025, when the S&P 500 number ticked just above whatever it was on February 19, the correction was technically ongoing.
That feels, I don't know, it feels strict. It feels like the market is holding a grudge. You're not forgiven yet.
It is strict,
Yeah.
but it's designed to prevent false hope. It prevents us from celebrating a dead cat bounce,
Right.
where the market jumps up a little bit for a day or two before continuing its fall.
Yeah.
The rule says you are not out of the woods until you are higher than you have ever been before. Only then is the old trend truly broken.
I like that. It's like you haven't recovered from a broken leg just because the cast is off.
Right.
You've recovered when you can run faster than you could before you broke it.
That is a perfect way to put it. You aren't just healing, you are surpassing.
Now, there is a really interesting quote in the source references about this whole in and out idea. It's from Mark DeCamber at MarketWatch. And I love this because it adds a bit of human frustration to all the math.
Yes, to Canberra.
Yeah.
He gets a little frustrated with the media coverage of these events. You can see why.
He says, and I'm quoting here, "Stop saying the Dow is moving in and out of correction. That is not how stock market moves work."
I can just hear the exacerbation in his voice. He's probably yelling at the television screens in the newsroom.
Totally. But what's he getting at there? Why is he so annoyed by that phrasing?
He's fighting against that day-to-day volatility sensationalism. You know how it goes.
Mm-hmm.
The market drops 10.1% on a Tuesday. So the news ticker says, breaking news, we're in a correction. Then on Wednesday, it bounces up a bit, so now it's only down 9.9% from the high, and they say, relief, we are out of correction. Then Thursday, it drops again.
It's exhausting. It's emotional whiplash. As an investor, you don't know whether you should be buying or selling or just hiding under your desk.
It's exhausting, and it's completely inaccurate. DeCamber's point, which aligns perfectly with the definition we just discussed, is that a correction is a status. It's a mode the market enters.
That's status, okay.
Once you trigger that 10% drop, you are in that status. You don't just toggle out of it because you have one good afternoon of trading.
Yeah.
You stay in that box until you hit a brand new high.
It's like being in a tunnel. You are in the tunnel until you exit the other side into the sunshine. You aren't out of the tunnel just because the lights got a little bit brighter in the middle for a second.
Exactly. And having that discipline helps investors stay calm. If you know you're in the tunnel, you stop reacting to every little flick of the switch. You just wait for the exit.
Mm-hmm.
You stop looking at the daily fluctuations, and you start looking for that new high.
Uh-huh.
You realize that until that new high is reached, everything else is just noise inside the tunnel.
That's a powerful mindset shift. Okay, so we've talked a lot about stocks, the S&P 500, the Dow, but the source mentions that this term isn't exclusive to Wall Street tickers, right?
No, not at all. The concept of a correction applies to almost any asset class that fluctuates in price. It's a universal economic principle, really.
And the source specifically mentions commodities.
Right. Think about oil, gold, wheat, copper. These things have prices, and those prices can get overheated, just like stocks.
Yeah.
When they drop by 10% or more from a recent peak, that is also called a correction. If oil goes from $100 a barrel down to $89, you'll hear the pundits on TV saying, oil is correcting.
And then there's the big one. The one that hits home for literally everyone, whether they invest or not. Housing.
The housing market. Yes, the source explicitly cites the 2000s United States housing market correction.
Ugh. Now that brings up some memories for a lot of people. That was a really painful time.
It does. And it shows that the mechanics are the same, even if the asset is different. Prices went up and up and up. They went too high. They detached from fundamental reality, and then they corrected violently.
But a housing correction feels very different from a stock correction, doesn't it? I mean, I can sell a stock in a second. I click a button on my phone and it's gone. You can't sell a house in a second.
That's absolutely true. The liquidity is completely different. You
Right.
can't day trade your bedroom. But the math is the same. And the underlying principle behind it is the same. The market is trying to find what the source calls the New equilibrium price.
New equilibrium price. That sounds very zen. It sounds very philosophical.
It is the most philosophical part of economics, I think. Think about what a correction is actually doing. Why does it happen? Why do we have to go through all this pain?
Yeah, why can't the line just go up forever in a nice, orderly fashion? That would be nice. Why can't my house just be worth more every single day?
Because eventually, buyers and sellers can't agree on the price anymore. The price gets too high, it gets irrational, and the buyers, they effectively go on strike.
They say, I'm out.
And they say, I'm not paying that. That's crazy. That price is not connected to reality.
So the market has to come down to find a level where people are willing to step in and buy again?
Correct. It is searching for balance. It is searching for that equilibrium. The correction is the mechanism the market uses to say, okay, we all got a little carried away. The hype was too much. The real sustainable value is somewhere down here.
So, in a way, is the correction the truth?
That is the profound way to put it. And I think, yes, the correction is the reality check. The boom might have been the fantasy. The bubble was the collective dream. The correction is gravity reasserting itself.
That actually makes me feel better about the whole thing. It's not a disaster. It's a reality check. It's the market fixing itself.
It is the market doing its job. A market that never corrects is a market that is lying to you. It's building up pressure that will lead to a much bigger problem down the road.
Okay, so let's try to summarize all of this. We've covered a lot of ground definitions, math, history, even a little philosophy. If we had to build an anatomy of a correction cheat sheet for our listeners, based on this source, what are the key body parts?
Okay, let's break it down. The essential checklist.
Do it.
Point 1, the trigger. It starts with a drop of more than 10%. That is a hard line. If it's 9.9%, it's a dip. If it's 10.1%, it's a correction.
Got it. 10% plus.
Point 2, the upper limit. It generally stops before 20%. If it breaks through that 20% floor, it morphs into the much scarier, much longer bear market.
The drought, not the flash flood.
Exactly. Point 3, the timeline. Remember those 3 adjectives, shorter, sharper, steeper. It happens fast. It's a shock, not a long, slow grind.
Okay.
And the last point, point 4, the exit. It is not over until you hit a new high. You have to break through the old ceiling to officially leave the room. Everything before that is just recovery within the correction.
And the example to keep in your head through all of this is 2025.
The 2025 S&P 500 event is the perfect case study. February to June, down 18.9%, scaring everyone to death, and then recovering to record heights just a couple of months later.
It really illustrates the transient nature of these things, doesn't it? It feels so permanent when you're in it, when you're in that gloomy month of March 2025, but the data shows it's just a passing phase.
A passing but necessary phase.
So what does all this mean for you, the listener? Why does knowing the definition of retrospective measurement actually help you on a Tuesday morning when your app is glowing red?
I think it provides a mental anchor. It provides context. When you see a 5% drop, you don't panic. You say, this is noise. The market does this. When you see a 12% drop, you don't despair. You can say, okay, this is a correction. It is sharp, it is steep, but history says it is likely to be short.
It stops you from catastrophizing. It stops you from immediately picturing that van down by the river.
Exactly. It gives you a framework to understand the chaos. You aren't just a victim of the market's whims. You are an observer of a defined economic phenomenon. You can detach yourself just a little from the raw emotion of it.
I love that. I am observing a phenomenon. I'm going to say that to myself next time my portfolio takes a hit.
It might not get your money back any faster, but it might lower your blood pressure. And honestly, that is worth something.
It really is. Before we wrap up, I want to go back to that idea you mentioned, the new equilibrium.
Okay.
Because it kind of haunts me, actually.
How so?
Well, if the correction is the market finding the correct price, does that mean that the previous high, the peak we were all celebrating on February 19, 2025 was incorrect?
That is the provocative question at the heart of all of this, isn't it?
Yeah.
If the market corrects down to find its true value, it implies that the peak was an illusion. It implies that for a little while, we were all agreeing on a price that wasn't real. We were all sort of sharing a collective hallucination of wealth.
And that makes you wonder what value really means. Is it what the chart says today? Or is it what the chart says after the storm finally clears?
Perhaps true value is only ever visible in the rearview mirror, just like the correction itself. You only know what something was truly worth after the market has stress tested it.
That is definitely something to mull over. The market is a test. And usually, if you just wait long enough, you pass.
Well said.
Thank you for taking this deep dive with us. Hopefully the next time that graph turns red, you won't just see a scary color. You'll see the math behind it.
You'll know exactly what to call it.